So I just wanted to recap on where we are so far, picking up on some of the points that both Gemma and Lee have discussed. So based on the advice given, we're going to settle, Tom and Steph are going to set up a will with a business asset trust in place so that the shares that qualify for business property relief can go in there for the benefit of the survivor and the children on first death. We've got a flexible life interest trust, as Gemma mentioned, so that the residue of the estate can be better managed and more flexible for the family going forwards. We're utilising a discounted gift trust, as Lee suggested, which gives some really significant upfront inheritance tax savings, but gives Tom and Steph the right to an income where it's needed. And unless otherwise needed in the future, the pension's going to be left well alone. So that's completely free from inheritance tax, and the beneficiaries are going to be named as the children, so it can pass along the generations. So if we combine all of that from a financial perspective, actually we're saving the client, just through those small steps, between £386,000 and £786,000 on second death. That depends on whether the company will still be qualifying as trading on at that point. But what Gemma's already highlighted is that the estate is still worth more than £2 million, and that's before inheritance tax reliefs are available. Therefore, the residence nil rate band, which you can claim against the value of your home, is not available in full. So the next step, therefore, is to look at what other options are available to see if we can fully maximise on that. And that residence nil rate band can be up to £140,000 in tax savings for a couple. So the best form of tax planning is to make a gift and survive the 7 years. Providing you do so, the value of the gift falls outside of your estate for inheritance tax purposes, and any uplift in value of that asset will be immediately disregarded. In order for lifetime planning to be effective, however, you do need to consider your income and capital needs. This is both in the short term and longer term throughout retirement. You should only therefore be looking to give away assets that you don't utilise or need access to in the future. Our recommendation is to always look at assets which are likely to appreciate in value over time. By making a gift now, whilst the value is lower, you are able to mitigate your potential lifetime tax charge whilst maximising on the future uplift outside of your estate. So looking at Tom and Steph's assets, we've already touched upon pensions, the savings have been utilised as a discounted gift trust. The ISAs are best kept transferred to the survivor due to their tax-free nature. So what else have we got to plan with? Well, we've still got some shares in a trading company because the planning that we've taken place so far is based on wills. We've got the rental property and we've got a paddock. And whilst we've still got the home, we would generally disregard any planning in relation to this because there is a mirage of anti-avoidance rules that are really hard to navigate through. So what are their options? So there's two types of things that they can consider: a direct gift to the children or a gift into trust for their benefit. Generally speaking, for inheritance tax purposes, providing Tom and Steph survive the full 7 years, then as mentioned, the value of that gift will be outside of their estate and maximising on the uplift outside of their estate also. For CGT purposes, however, a gift of a non-cash asset is a deemed disposal. So capital gains tax could be payable on the difference between the market value of the asset at the date of gift and the original cost to them. For both inheritance tax and capital gains tax, there are some subtle differences between the two options, which we'll explore later in the presentation. And it is worth noting that a trust does come with its own income tax considerations. Therefore, should Tom and Steph want to instigate lifetime planning with the use of a trust, we need to talk through them with those aspects with them to ensure that they fully understand the position before they go ahead with it. So on a direct gift, the advantages focus on the simplicity of the option. Furthermore, there is no restriction on value that you can give away. So Tom and Steph could give away £1 million today, and providing they survive the full 7 years, that £1 million is completely disregarded for their inheritance tax position. The main disadvantage, however, is the loss of control. As soon as the asset is gifted, they no longer have a say in how it's managed or utilised. And this is often a really key aspect to speaking with clients when they're giving away high-value assets, especially, like in Tom and Steph's situation, they've got young children who do not have the financial maturity to deal with high-value assets themselves. And as already mentioned, a direct gift of a non-cash asset will trigger a capital gains tax liability, and that tax would need to be funded from their own cash, so it's yet another cost to factor in. If we look at a trust as an option, the advantages focus on the ability to retain control over that asset, especially whilst the children are young. For example, Ben could have access to income during his days in university, and then when Jess goes off to university, that money could be redirected for her benefit. A trust also affords greater protection against divorce and financial difficulties of those individual beneficiaries. The other key advantage is that the asset being gifted, where it has an inherent gain, you can hold over the capital gains tax liability when you transfer an asset into trust. You can therefore defer that tax payment and not have to suffer that yourself. The use of a trust, however, is quite restrictive in the sense that as soon as you put more than £650,000 in a trust per couple over a 7-year period, there is a lifetime inheritance tax charge to consider. This is at a rate of 20% of that excess. A trust will also be subject to periodic charges every 10 years, but this is at a maximum rate of 6% over and above the nil rate band at that time, so £650,000 per couple in this instance. So although there is a periodic charge, actually it is still generally cheaper over multiple generations to put your assets into a trust compared with having it in your estate on your death. A trust will also have additional administrative considerations, and as already mentioned, it will need to be registered with HMRC on the Trust Registration Service, so that's yet another thing to factor in, but don't be put off by it. So looking specifically at the assets that Tom and Steph have, they've identified that the income from the rental property is no longer required. They're receiving sufficient income from their other assets, namely the trading company. So if we look at a direct gift first, for inheritance tax purposes, they've given them a gift worth £325,000. Providing they survive the 7 years, they've saved at least £130,000 in inheritance tax, assuming that the property value does go up. However, for CGT purposes, they've triggered a capital gains tax liability. As they purchased the property for £200,000, they've got about £28,000 of tax to pay as high rate taxpayers. This is payable within 60 days of the gift because it's residential property. So overall, we have a net saving of £102,000. As the children are young, Tom and Steph do have some issues around potentially giving them the asset direct. They also want the flexibility of allowing to manage the income between the different children at different points in their lives, which if you give a property direct to individuals, they will be entitled to a fixed share of that property and that income. The other thing to note is because 2 of the children are under 18, the income will be taxable on Tom and Steph until they reach adulthood. So whilst it's not necessarily, it could be an extra cost in the short term that they weren't perceiving. So we look at a trust for Tom and Steph, because in contrast, this will allow Tom and Steph to A, defer the capital gains tax, and whilst this is only a deferral, it doesn't remove the liability, it does give you the opportunity to match the tax liability with the cash proceeds should the property be sold in the future. There is always a risk that if capital gains tax rates go up, as Daniel suggested in his introduction, that by holding over the gain, you are likely to pay more tax on that sale of the property in the future. However, Tom and Steph are happy to take this risk. As the inheritance tax savings are the same for the transfer into the trust as they are a direct gift. So overall, we're looking at £130,000 net saving after 7 years, again, assuming the property value doesn't go up. Because 2 of the children are under the age of 18, what I did highlight to Tom and Steph was actually the trust should only be set up for Ben initially, because otherwise you haven't got the ability to hold over that capital gain. But you can appoint beneficiaries in the future. So as soon as Jess and Jake turns 18, they can be added to the trust and benefit from the assets longer term. The other asset that jumped out was the paddocks. And as Gemma mentioned, Tom and Steph have already been approached by developers a couple of times. So whilst the paddocks is only worth £25,000 at the moment, in a couple of years' time, it could be worth significantly more than that. This is therefore an ideal asset to transfer now and maximise on the lower tax position. If we look at a direct gift and a trust gift in tandem, actually the tax position is no different under either option. The initial tax saving for inheritance tax purposes is £10,000, not significant, but it's the future value and the future tax savings in the uplift in value that is key here. For capital gains tax, whilst we can't hold over the gain on a direct gift, because of the values concerned, the gain would be covered by their annual exemption, so the £12,300 that Lee mentioned earlier. So there's no tax payable in any event. So Tom and Steph like the idea of transferring this now, whilst the value is low, but they would like to put it into a trust for that asset protection element whilst children are young, especially as they don't really know what's going to happen with that land longer term. The only point to note out which is different to this versus the rental property, however, is that they want to maintain use of the paddocks in the short term. So to get around this and ensure it's effective for inheritance tax purposes, they can pay a rent for the use of that land. And given the size of the plot, actually it's a relatively minimal cost each year. So the final asset I wanted to talk about was the trading company shares. Gemma's already discussed the benefit of a BPR trust in the will, and Tom and Steph have agreed to adopt that approach. However, there can be some benefits to transferring those assets during your lifetime. In order to qualify for business property relief, these shares have to be in a trading company, and this has to be wholly or mainly trading, which is a 50% test. This looks at turnover, profitability, assets employed, and time spent. Where a successful trading business has built up significant cash balances over time, or got a rental portfolio of surplus property that's no longer being used by the trade, then this could all potentially prejudice a claim for business property relief in the future. As Dan has already mentioned, we're also expecting the potential for the 50% test to go up to 80% in due course. So for a number of companies, 50% might be achievable, but 80% is nowhere close. Finally, if at the point where Tom or Steph pass, there is a binding contract for sale on the company, then business property relief is not available, even if the company is trading. So there are a number of circumstances why giving away shares now, whilst they qualify for relief, can be really effective. Whether the gift is into a trust or directly, then the value for inheritance tax purposes as it stands is nil. So you could give away quite significant value without triggering any kind of tax bill. Furthermore, even if you're making a direct gift of the shares, it should be possible to hold over the capital gain. So again, transferring value with no upfront tax cost. In speaking with Tom and Steph, they're really interested in this concept. However, at the moment, they just want to focus on the other two assets. So we've agreed to park this for now. Therefore, we're going to revisit this in 6 to 12 months' time, once things have settled down. And the other point to note, which we would pick up with Tom and Steph in due course, is that if a gift of these qualifying assets do take place during your lifetime, and you were to die within 7 years, then that business property relief may not be available due to the company being sold, for example, or the trading status having changed, in which instance you would bring back the value of the shares into your estate, but it would be valued based on today's value when I made the gift, not what it was worth in 3, 4, 5 years' time. So there's still a benefit to doing it. The other point around giving shares in trading companies is, although on the face of it you're giving away nothing from an inheritance tax perspective, I mentioned earlier about the residence nil rate band and the fact that you have to have an estate worth less than 2 million to qualify in full. Well, that £2 million threshold is before you take into account business property relief. So if you can shift some value in shares, bringing your gross estate down to below 2 million, you're therefore maximising on that allowance also. So what have we agreed? We're going to set up a trust whilst the children are young. We're going to set it up for Ben initially with the power to appoint beneficiaries in the future. We're going to transfer the rental property in the paddocks. And then in the future, we are going to look to transfer shares, securing reliefs whilst they're still available. Whilst the value of the assets being transferred into a trust, including a discounted gift trust that Lee mentioned earlier, are below £650,000, we're going to have no upfront tax costs in doing this. So in financial terms, with the planning agreed with Tom and Steph, it will result in either no inheritance tax liability on second death or a reduction to around £376,000 if that were not the case. In either event, we're making significant savings for them from an inheritance tax perspective, potentially up to £1 million if the company is sold in the future.